Hey everybody, I hope you're having a great Labor Day weekend, and I see that the market on Thursday and Friday gave us a little bit of a shake, but that's okay. We'll cover it all and tell you what to do. So let's dive right in. Hey everybody, Courtney Smith here with our September 7th Wall Street winners, coming to you since 1995. All right, and this has been coming to you since forever. All right, S&P, we obviously broke to new highs, but then we had a shocking collapse on Thursday and Friday. Now, when you look at this chart, it doesn't look like a big deal, but emotionally it seemed to affect people a lot. We got tons of emails and phone calls into our office about what should they do. But of course, that's why you're a subscriber, hopefully a fully paid up member, but even watching the freebie is going to help you out an awful lot. Now, one of the things to consider is that Thursday was down sharply. We opened on the high and we closed near the low. But if you look at Friday, we closed above the middle of the day. In other words, actually, after the opening, there was more buying pressure than selling pressure. So it's not as bad a looking day as it looks. Let's keep going. Over here. The selling pressure, which is the red line, never got above the green line, which is the buying pressure. That's not so bearish. This is the Dow. And finally, what about the NASDAQ? The NASDAQ climbed all the way back to almost break even. So that's not so bad either. So actually, although the market cracked, and we have to respect the size of the move from the high to the low, it's not a clear-cut sell signal, but it does make things easy for us. Let's keep going through our indicators, and then I'll tell you what I'm going to be doing. So the seasonality for the stock market still remains neutral. Starting on September 30th, or actually really starting in September, we can start to think about getting bullish. If it breaks to new all-time highs, the IWM, which is the Russell 2000, then I'm going to turn this indicator to bullish. Now, utilities are usually bullish from May 1st to October 31st. So we still have a little bit of time that we might want to get long Utes. But if we look at the Utes, we really need to get above the highs that we made in early June before I'd want to get bullish, and it doesn't look like that's going to happen. So no bull market in utilities this summer. Okay, seasonality. So technically we are looking at the green line. The green line is the seasonality when there is a sitting president running. And you can see that it's bullish during this period of time. Now, we've just gotten into the time where people start to actually look at the election and start to make investment decisions about the election because of the election, okay? And one of the considerations that caused the Thursday and Friday crack in the market was ideas that on the morning of November 4th, we won't know who the president is. We saw several, I think 3 primaries that were done through mail-in ballots, and the average number of ballots that were rejected was 20%. And in New York State, I think it was 25%. So the point is that, are the 20% being rejected because of good reasons, like they didn't sign their name or they signed Mickey Mouse? Or are the ballots being rejected because they signed it Bob Jones instead of Robert Jones, which is what's on their ID? And of course, the decision of do you reject Bob and only allow Robert, or do you allow Bob because Bob is obviously a diminutive of Robert? That's going to be up to the poll watcher. And then, of course, we're leaving out pure and outright fraud of throwing away ballots and ballot harvesting in an illegal manner and so on and so forth. So the idea is that we're not going to know who the president is on November 4th. But the United States has an almost 250-year history of transferring power from one president to another easily, quickly, quietly. Only really, I mean, there's been a couple of times where it was dumbfounding when Dewey lost to Truman. But in the modern era, Gore, Bush, we didn't know who the president was technically for some time. And in 2016, Hillary still hasn't given up the fight. She's still claiming she was ripped off. Okay, so we're getting more and more complaints from losers that they were ripped off. So it doesn't matter if every ballot was legitimately counted on November 3rd and 4th. We're going to see lawsuits that are going to drag out the count for weeks and probably months. And in particular, we're going to see some congressional ballot in Butte, Montana or something, and it's just going to go on forever, and they're going to do a recount, and we're going to go through Florida over and over and over again across the country, unless it's a complete blowout by either Biden or Trump, we're going to see that on the national level as well. So the market is shaky because of that. They don't like uncertainty, and not knowing who the president is a major source of uncertainty as to future economic and economic policies. So that's starting to freak them out because now the market's starting to look at the market. Okay, so that's starting to come up. And of course, the policies of the two gentlemen running and the two parties running are also going to come into play. So that's probably why we saw the crack in the market. Plus, it was overdone. Fully paid up members were going to go into detail on what was going on because I already had told you what was going on. If you're not a fully paid up member, what's the matter with you? All right? What's the matter with you? All right, so the green box is what we should be looking at, but I'm just not feeling the bullish seasonality here. My feeling is that some of these things that I just mentioned, plus other things, are going to put us more into the blue camp, which is supposedly just for all election years. Right now I'm going to leave out the red line, which is if it's an open field, because we don't have an open field. We know very well who these two gentlemen are. Okay, so a lot of these indicators really did nothing. So our yield curve, very stable, so nothing to talk about. The asset allocation started to come back in favor of the bonds. In other words, what happened was the market, we saw the market crack, and markets started to go back into the bond market. Our stock market risk indicator, a little bit higher, meaning, believe it or not, after all that, they were willing to take more risk. Global shares also cracked, but notice they actually closed higher on the day. So they weren't even lower. It's still a crack. They still broke to new lows. Bonds were showing some good strength early in the week, and then on Friday they bailed as well. So money went into the bond market, but it didn't help. Bond key factors still suggest we should see higher interest rates, which means lower prices. Okay, that's what all these indicators are telling us. So the market is fighting, I'm sorry, not the market, the price of bonds is fighting the market. The market says we should have higher rates. Well, if interest rates aren't going higher the way the market says it should be, that means probably the Fed's actions of buying investment-grade corporate bonds and treasury bonds are having an impact. Now, the Fed's not going out and buying a lot of treasury bonds in the open market. But what they are doing is buying all the treasuries that the Treasury is issuing. So August is one of the quarterly refunding auctions, and they issue 10-year and 30-year bonds, 10-year notes, 30-year bonds, and the Fed just bought them all. The Fed just said, oh, well, I'll buy them all. So what that means is people who wanted to buy them were crowded out of the market and had to buy corporate bonds. But we also know the Fed's buying corporate bonds. So they have to bid up the price, which lowers the interest rates. So I think that the Fed is still manipulating interest rates on the long end of the yield curve. Okay, dollar has shown some stability down here. Where it's a slight bear market. I'm not really doing much here in the currencies, but gold I'm very interested in. Now it sold off here late in the week, okay? And normally when a stock market makes a sharp down move, people sell gold in order to make their margin calls. They get the cash from their gold sales, and they shore up their stock market portfolios. But shortly after that, gold starts to go up on expectations of more Fed easing. I think because of the March-April experience, gold's not going to go down very much, even if we go into a major bear market, because we already did that. Everybody's prepared for it. And so as a result, really not much of a down move if we get a crash in the stock market. And we may have already finished it, or maybe we'll go down a few days, a mild, and then it'll start to go up. And we're going to see a major bull move again if we get a crash in the stock market. Right now, we're just in a stable market, but I believe that the fundamentals are really somewhat bullish. However, looking at our indicators here, pretty much neutral, okay? Pretty much neutral because the dollar has stabilized. That's a big thing. Commodity prices still creeping higher, so we might call that one kind of a little bullish. But generally speaking, right now, gold is going sideways in the face of a sharp crack in the stock market. And that's actually bullish price action. If the gold market is basically stable when the stock market cracks, that means as soon as the stock market stabilizes, we're going to see gold skyrocket. Okay, crude oil started to come under pressure because, of course, if the stock market cracks, that means that the economy is going to weaken, and of course, that is bad for the demand for crude oil. So look for it to go down to maybe we'll get back down to $35 a barrel, something like that. But I don't think it's going to go much below that because the economy actually is improving. We saw that in Friday's unemployment number, which saw 1.8 million new jobs. That's a tremendous number. And the unemployment rate got down into the low 8% level. So steps in the right direction, still not good, but that was a big drop in the unemployment rate. Bitcoin cracked. Now, I told you that I'd rather be long than short, but I had no position, and thankfully I didn't have a position. So the purple predictor had been quite bullish, but now it's on the bearish side. And so that would suggest that the breakdown that we saw, first of all, it put Bitcoin into a bear market. We're making lower highs and lower lows. And now the purple predictor is saying that the smart money's bailing out. And I think what they're saying is we need cash to support our stock market positions. We need cash. And they don't want Bitcoin. They need cash in their margin account. So they're selling Bitcoin and sold some gold and sold some bonds to support their stock market positions. So this is going to take a little while to build a base to make any further rally, but I think that it will make a further rally, but we're going to first have to follow the stock market down for a little bit if the stock market goes down. But right now it's just going to be similar to the stock market. Okay, thanks freebies very much. Fully paid up members, hold on for just a second.